All right, so ladies and gentlemen, you are welcome to lecture 11 or chapter 11 of our Principles of Taxation study. Here we are looking at realization. Realization. All right. Okay, so what is realization? Realization simply means parting away with something. All right, so you are parting away, all right, with an asset or a liability, parting away. So that is the key. And there are so many ways one can part away with something. To part away with something, you can actually sell it. It means that you parted away with it. You can actually exchange it in a barter. It means you parted away with it. You can actually transfer the thing to someone. It means you parted with it. You can actually distribute it. So long as the thing is not with you anymore, all right, that is it. You can actually redeem it, the liability. You can actually destroy the thing. You can actually lose the thing. So the thing gets lost. That's expired. You can't use it again. You can actually surrender the thing. You can actually give it out, which is another meaning of transfer, not those things. So all these means that you are parting away. All right. Whether it's an asset, you are parting away with it. If it's a liability, if you pay it off, all right, then it means that you parted away. All right. So that is that. Okay. Now, again, you could see here that we've said that in the case of an asset of a person who ceases to exist, including by reason of death, all right, if you die, you've also parted away with that. All right, so that is that. Now, we said that in the case, so in the case of an asset, it includes death. And in the case of a trading stock or a depreciable asset, we are talking about if the sum of the consideration received by the person from the sale exceeds the cost of the asset, all right, you've also parted away. All right, so basically, that is what we mean. All right, now, when we talk of assets, we mean so many type of assets. All right, first of all, you could see that we have a depreciable asset, which we've studied something on in terms of our capital allowance. All right, an asset that you use in the production of an income that makes it subject to wear and tear, all right, obsolescence, all right, or passage of time. But the key thing is that it never included the goodwill. Do you remember? Goodwill wasn't part, and interest in land. So land, we never dealt with those things as depreciable asset. They were not depreciable asset, if you remember. All right, so that is that. That is that. And again, here we add that the management interest in an entity, all right, and a trading stock are all not part. So management interest in an entity. So like share-based payment, if you have an interest in it, and trading stock, they are all not part. So not a depreciable asset. These things are not depreciable assets. All right. There are another type of assets we learned from when we were dealing with the income tax, business income. We also learned of trading stock. Okay, so here we talked about depreciable assets. We also learned about another asset called trading stock. All right, if you remember. And we said that these are basically what you deal with in your daily course of activity. So we made reference to IAS 2, all right, like financial reporting. So those are that. And again, we have another type of asset called what? Capital asset. Okay, so capital asset includes those assets you employ in your business or investment, but they also exclude depreciable asset and trading stock. All right, so that is that. Then we have investment assets. So investment asset includes capital assets, all right, that you hold in investment. All right, so that like shares, securities, okay, interest you have in trust and all those things. So those are the type categories of assets that we have. All right. So capital asset. So you've heard that investment asset includes capital assets. All right. So that is that. We talk about capital assets in those that are employed in business or investment. This one to capital asset had as part of investment that have been like what shares and all those things. All right. So basically, that is that. So you know the various types of the assets. All right. So get to know these ones. All right. So after knowing those assets, then we come to the liabilities. We talk about liabilities. Liability is what you owe. All right. What you owe. And you can part away with the liability if you pay it off, if you satisfy it, if you cancel it, or if it has expired. All right. So all these things you must also understand. But immediately before a person ceases to exist, including reason by birth, if the person is dead, you can't go and chase him. That person that is dead, there is nothing you can do. You can't chase the person. All right. So basically, these are things that you are supposed to understand. All right. Again, we said that you parting away with something may include a situation where an underlying entity changes ownership within 3 years from about more than 50%. Okay, so if you change your ownership structure within 3 years, all right, like more than 50%, then it means that there is also a realization according to section 62. We'll come back to this particular statement later. All right, so basically that is that. Now, why we are doing realization is because we want to tax the gain on the realization. So that is basically our reason. So how do we tax gain? Gain on realization. So before we can tax the gain on realization, which is section 35, what we need is that we need to understand what a gain is. What is a gain? A gain is when the proceeds that you receive, or what we call consideration. So another name for the proceed is the consideration received, is greater than what? The cost, all right, of the asset. So that is what a gain means. So if there is a loss, then it means that the cost is rather greater. All right, that is that. Now, what is cost, therefore? What is cost? Now, here, cost includes everything that you've incurred in acquiring, authoring, maintaining, repairing, everything. So here, pick the definition of a like a PPE, any other cost incurred in bringing the asset into its saleable condition. So it includes the purchase cost and all costs that you have incurred in bringing the thing into the point where you are what? Selling. So it includes the acquisition cost, the authoring of it, the improving, the maintaining, the repairing, the incidental expenditure incurred in acquiring, and all those things. All right. So it includes all those costs. So cost includes purchase price plus all other costs you have to incur to the point of selling the thing. All right. So these are what we are talking about. These are what we are talking about. Everything, advertisement, every cost you have to incur because you are selling the thing. All right. So that is that. So that goes into the cost. All right. Then the consideration received. Consideration received is the amount that you receive from transferring the asset to another person. All right. So that is that. So that is what we are talking about. Amount received by a person for owning an asset. All right. So that is that. So the money I take, all right, to give you my asset. All right. So please take note of that. Now, consideration does not include exempt amounts, final withholding payments, or amount directly included in the person's income calculation. All right. So please take note of that. And again, the exclusion of final withholding tax does not apply to the trading stock in this case. All right. So please get to know of that. All right. Please get to know of that. And of course, what we learn in section 41 is just absorption costing. All right. So it just tells you that we use absorption costing in pricing something. What is absorption costing? So absorption costing refers to all the costs. All right. So not the marginal absorption, even fixed costs attributable to the thing apart. So the direct cost, the direct labor, and what attributable factory overheads are all part. So that is what section 41 talks about. All right. So that is how you can get, the gain of an asset. All right. So in a question where we have to discuss the calculation of the gain, we will discuss the calculation of the gain, how we do the computation. All right. Now let's go to the forms of realization that will happen, because don't forget, we said that realization is you what parting away with something. Now we say realization with retention. What is realization with retention? You part away with the thing by selling, but the thing is still with you. So you've parted away with the thing, and the thing is still with you. All right. It's like you sold it, you bought it back, kind of. All right. So in that case, what will happen is that where a person realizes an asset, all right, that person is treated as having what parted away with the ownership of the asset, and in that case, he has derived an amount that is equal to the market value of the asset at the time, all right, that he sold the asset. So what we are selling, we are actually basically telling you is that if you sold the asset, what you've realized, the consideration, all right, is the market value. All right. So if I sell my assets, let's say I sell A sells to B, all right, whatever B will give, all right, it should be the market value. If it is not the market value, we will use the market value. Like the example we had in the business income, where somebody actually sold shares, that kind of thing, and we had to add back the gain. So you use the market value. But when a person reacquires the thing, it means that he has also bought the thing. So it's like if this one sold, now he's buying. What the law is basically saying is that the market value which this person gave is the same market value with which he is buying. And so therefore, there is no gain. All right. So you sold the thing, you collected the money, you bought the thing. The value of the money that you used to buy the thing is the same as the value of money you collected when you were selling. So the effect is that the cost is equal to the consideration, and therefore there is no gain, and therefore there is no what tax. So if there is a realization with retention, there is no tax effect. All right, there is no tax. So there won't be any gain for a tax. Realization with retention. All right. Again, we have transfer of asset to spouse or former spouse. These things happen more often when there is a divorce settlement. All right. So that is that. Or sometimes to when the person is dead and we have to transfer the person to transfer the asset to another person. So it says that where on the death or part of a divorce settlement or a bona fide separation agreement, an individual transfer asset to a spouse, all right, or a former spouse, that individual is treated as having what departed with the asset, i.e., therefore derive an amount in respect of a realization. All right. So what basically we are saying is that the amount you realize is equal to the net cost of the asset immediately before selling it. So what we are saying is that if you are transferring it to your spouse, your cost will be equal to what? Your consideration. And therefore, that one too will mean that no gain for us to tax. So there is also no gain. But whoever received the assets, all right, if that person now later sells the asset, then it means there will be a gain. All right, so that is that. So it says that, but the recipient may be liable for tax for future what realization of the same what asset. So as far as the transfer is concerned, there is no tax effect. All right, transfer of debt. Transfer of an asset on debt. Again, here to the same thing, where a person realizes asset, departed from the asset by way of death. It is also deemed that the market value of the asset is the money the person has realized at the time of what? The death. All right, immediately before the death, that is the value. So the person who acquires the asset is treated as also incurring an amount that is equal to the same. So here too, what you see is that the cost is also equal to the consideration. All right, the consideration. So we says that the estate or the heir of the deceased person is required to determine the gain if there is any and pay tax accordingly. So that is what we are saying. So the person who acquires the asset is treated as incurring an expenditure of the same amount, all right, as in acquiring the asset. So it's like the money, the amount the person derived in respect of the realization is equal to the value of the asset, all right, the market value of the asset. So that is what we mean. So at the time the person was dying, we say that the consideration is equal to the market value of the asset. All right, the consideration is the market value of that. And the person who acquires the asset is also treated as a person who is incurring an expenditure of an amount same as, all right, same as in acquiring the asset. So how much are you going to incur if you are acquiring the asset? So if they transfer an asset on death, on the death of a person, how much was the asset at the time of what? The person's death, and how much will it be if the person is going to acquire an asset? If it is, so normally you realize that they make it so equal that they are buying the thing at equal the amount. All right. So you see here that in effect, the estate must apply the fair value less the cost of acquisition. All right. Cost of acquisition, improving the asset, and any other direct cost of the inheritance. So usually you may not have a tax also on that. But if there is a fact that all the costs you incurred in acquiring and changing certain things about the thing is lesser, then there will be a gain. All right. There will be a gain. So usually on death, you realize that they will work everything together and there will not even be any tax implication. All right. So that is that. Now, we come to realization of an asset for no consideration. Now, if you realize an asset and you don't collect anything, what is going to happen is that we are going to use the market value. All right. So an amount derived, the amount derived will be equal to the market value or the net cost of the asset. All right. Whichever one is what? Greater, or at the time of realization. So if there is no consideration, we will use the market value or what? Net cost. What is net cost? Net cost, we are talking about the net realizable value. All right. So whichever one is greater is what we will use. All right. On the other hand, so this one will be our what? Consideration. On the other hand, what will form our cost? The person who acquires the thing, all right, of the assets. So similarly, a person who acquires ownership of the assets realized under these circumstances, all right, will also be seen as incurred carrying an amount that is also equal to what? The market value of the asset or the net cost, all right, immediately before what? The acquisition. So immediately before the acquisition, what is the net cost? All right, that one too, we use the market value. So this one is at realization, the time the person departed. But you realize that the time the person departed is the same time the person was acquired. All right. So we use the market value or the net cost. So you realize that in that instance too, hardly will you get what? A tax. All right. Hardly will you get any tax, any gain to tax. All right. So basically, that is that. All right. Now, you realize that these transfers with no considerations can be happening within related party transactions and also all that. So if you want to determine the market value, you have to check, all right, who is buying the thing. You have to check all those things. Is it an associate, is it a related party transaction, and all those things. So there is always no tax effect, all right, but sometimes the Commissioner General may recharacterize certain things, all right, may recharacterize certain things, and therefore cause some gains to appear for you to be taxed. All right, let's look at this important one. Realization with replacement. Realization of asset with replacement. This is very, very key, and it is important. Now, this is it. This law says that if I am selling an asset, and please, the assets we are talking about here, we are talking about capital assets, all right? We are talking about capital assets. So this may include the shares. This may include interest in land. all right, securities, and all those things. Not depreciable assets. So bear in mind, all right, bear in mind. Now, what Section 46 is talking about is very interesting. So it says that if you sell an asset, so we are talking about replacement. If I sell my land, which is a capital asset, and I replace it 1 year or 12 months, 1 year or 12 months after my selling, it is called what? Replacement. So I sell the land and I buy another land, right? I buy another land, which is 1 year after I sold, it is called replacement. Or if I sell my land 6 months, or let me call it like this. If I buy a land, buy land 6 months to selling this one, that one too is called what? Replacement. So realization with replacement means that I bought a land 6 months, then 6 months later I sold a land that I have. So it's the same type of asset, okay? So that is what we call replacement. And if that thing happens, there is a way we do the computation. So I'm going to use the illustration there to help you understand it. All right, so this is it. So if I buy a land, then 6 months later I sell what I had before, or if I sell what I have now and buy the same land, all right, 1 year later, it is called what? Replacement. The calculation of that is interesting, and I'm going to use it to explain something to you. Now, first of all, you must understand that so far as you have a gain, you should be taxed, all right? So we said that the gain is when the consideration is greater than what? The cost. And when that happens, you have a gain, all right? So that is that. You should be taxed, all right? How are you taxed on the gain? You can add it to your business income and tax it at 25%. Or if it is investment, you can also decide to tax it at 15%, all right? Yeah, 15%, all right, isolatedly. Now, let's see how this calculation is done. So look at this. Sadio bought land in Committee 22 in 2015 at a price of what? 2.4 to an investment property. So you see that we are looking at investment here. All right, it's a capital asset or investment asset. All right. Then in 2020, Sadio decides selling the land to buy another at cantonment. A sale of was therefore effected. So this was the day the realization happened. For 6 million. So that is how much he's selling it for. But he incurs some cost, which is 6,000 for advertisements and 3,000 for valuation. All right. So he says that he was able to buy another land at cantonment on September 2020. Okay, so let's make this one 2022. All right. He was able to buy 2022 and registered the land at the Lands Commission. Now, what happens? What happens is that for the consideration received, you see that Sadio received 6 million. Is that not it? And what is the cost? Cost of the thing was 2.4 million plus the cost he incurred in selling, which is 6,000, and what? The 3,000. So the total cost will be what? 2,409,000. This is 6 million. So the difference, which is the gain, should actually give us what? 3,591. So under normal circumstance, we should be taxing this. But because he bought another one, let's see the date he bought the other one, which is September. All right. We said that if you buy another one after selling within 1 year, so September is within 1 year. All right. What is going to happen is it's a good news for you. And this thing you must let your entities see these things clearly. All right. What is going to happen is that we cannot tax this one. We cannot tax this one. But what is happening is that the net cost of the replacement, all right, must be calculated. What is the net cost of the replacement? You see, we are told that after he sold this one and had this, he actually replaced it. What was the cost of replacing it? And as you can see, the cost of replacing it, he had to go and buy another land again for 4.8. So he had to go and buy another land for 4.8. So what we are trying to say is that the replacement was 4.8. Not only that, he spent additional 4,000 in registering it. So it means that the total replacement is 4.488. Here will be 4. Yeah, so this is the total replacement. Now, we now need to find what we call the net cost. The net cost. What is the net cost? The net cost, therefore, is this 6 million minus this 4804, all right, which is going to give us 1196 million. Now, you see this figure that we have here is the net cost. Now, what is going to happen is that instead of taxing this figure, we are going to subtract the benefit of replacing it. So what will happen is that we will now have, it is replaced, so we will now have 19500 less 1196 400, right? 1196,000, sorry, 1196,000. All right. So in total, what we are going to have after deducting these figures is that we are going to have 2,395,000. All right. So basically, that is what we have. All right. So you're going to pick those two figures and you do the subtraction. You realize that that is how much you have. So if you pick these two now, that is what you are going to tax. So it is on this we are actually going to tax. So you can elect to treat this thing as 15%. You can tax it at 15%. All right. Or you can add it to your business income, all right, to determine your tax payable on that. So, ladies and gentlemen, that is how you do realization with what? Replacement. Realization with replacement. So you don't just tax because the person replaced it. How much did he replace it with? This is the amount. So you deduct, all right, the gain that the proceed that you have from this figure. The net cost is deducted from what you would have taxed at 15%. This one, all right. So you can tax this one 15%, or you can choose to add this whole figure to your business income and tax it at the respective tax rate. So if it is 25%, then you use 25%. All right. So that is that. So if you read the law, let the law now make sense to you. It says that where a person, departs with an asset, all right, and immediately acquires an asset of the same time to replace that asset. Okay, that was realized. The acquisition was done within 6 months before. So the 6 months should be before the date of realization, or it should be like within 1 year after the realization. That person is treated as having what? Replace the assets, as derive an amount on an income to the net cost of the asset immediately before the realization, and any excess received over the expenditure incurred in acquiring the replaced assets. All right. So it says that it will be treated as incurring an expenditure. So it means that this one is treated as an additional expenditure. All right, an additional expenditure, which is equal to the amount derived in respect of the realization and any other additional cost. So what we are saying is that this one becomes additional expenditure for replacing the same asset, and therefore this is the figure that you tax. All right, so anytime there is replacement, just please look out for that. All right, so basically that is that. All right, let's look at realization by merger and amalgamation. If there is a realization by merger and amalgamation, and that merger or the acquisition or whatever it is doesn't exceed 50%, there is no tax effect if it doesn't exceed 50%. So let's say company A, which is 100% owned, company B, which is also 100% owned. Now, if this man goes to buy 50% of this entity, all right, which means that this entity will be left with what? 50%. It is deemed not realized. It means they've not sold anything. But immediately they acquired something like 60%, which means that these people will be left with what? 40%. Then it means that this company is deemed realized. All right. So be very, very careful. Very, very careful. All right. So we have other ones like transfer by way of security, finance lease. So finance lease, you need to be very careful to understand what a finance lease is. Okay. So in terms of finance lease, it means that you have transferred the asset, and this is IFRS 16. Okay. It means that you transfer the asset to the lessee, and the lessee is kind of having more, or let's say if the asset has 10 years useful life, the lessee have more of the useful life. All right. So you transfer all those assets kind of. So it says that when a person grants a mortgage or similar security over an asset to secure a debt, the mortgage is still considered the mortgage is still considered the owner, or the mortgager, the person who gave the asset is still considered the owner. All right. So that is that. While the person who mortgaged the asset owns the secured debt, but not the asset. So that is it. So what we are trying to say is that if there is a finance lease, what we are saying is that in a finance lease, the lessor is treated as transferring ownership of the asset to the lessee. Okay. And in installment, so in a mortgage, we says that the asset will still be with the bank until the person has finished paying everything. All right. So that is that. That is that. So in a lease too, it means that finance lease, what we are saying here is that the lessor is treated as transferring the ownership of the asset to the lessee. All right. So that is that. That is that. Okay. So now, what you should also understand is that in an installment sale or finance lease, the transferor is treated as deriving an amount equal to the market value of the asset, and the transferee is treated as incurring an expenditure that is equal to what? That same amount. So it's like IFRS 16, okay? Right of use, lease liability. All right, so that is that. Okay. All right. Now, realization by separation. That is something we spoke about. All right. So it depends on the the type of separation. Separation can be a divorce or anything. All right. So what happens is that it says that where the right or an obligation with respect to an asset owned by a person is created in another person, including what lease of an asset or part away of an asset. If the right or obligation is what permanent, that person is treated as realizing part of the asset, but it is not treated as what acquiring what a new asset or a liability, all right, or any temporary or contingent, or is temporary or contingent, that the person is not what treated as realizing the part of the asset or the liability. All right. So in this case, you see that the right, which is the asset, or the obligation, which is the liability, is considered what permanent. All right, where a person is actually having the right or the obligation lasting for what more than 50 years. So once that thing lasts for 50 years, it means that it stays with you. All right, it stays with you. Okay, so basically, these are things that you are supposed to understand. Okay, so that is that. Apportionment of cost and consideration received. It goes with the assets together. Okay, so you can use the market value, but it must go to the asset. You can't take some asset consideration for another asset. All right, so each and every asset has its own consideration. All right. So that is that. Sometimes too, like we saw in the other videos, entity transfers things to their members, shareholders. Okay, when it happens like that, a transaction between the entity and the shareholder must be at market value. All right, it must be at market value. If it is not, if they do anything of related party transaction or transfer pricing manipulation inside there, the CJ can characterize the transaction, all right, to obtain some tax gains, and those ones will be taxed. Most importantly is this one, is the change in ownership, section 62, highly examinable. It is most of the time examined. Almost all the time, that one is examined. So please take note of that one, all right? Take note of that one. What does it mean? What we are saying is that if within 3 years, an entity changes its ownership structure, within 3 years, all right, by more than 50%, so we just mentioned this, all right, if this thing happened within 3 years, that entity, so like I said, A is 100% owned, B is also 100% owned. All of a sudden, B now sells 60% to these people. All right, what this means is that A, and if all these things happen within 3 years, B is deemed realized. So since it is realized, it means it doesn't exist, because more than 60% means that you only retain 40% and you don't have control. B will now have control. It means the asset, the company actually belongs to what? A. So therefore, if that happens, the entity B shall not deduct any finance cost. Every finance cost that was there before the change will not be for him anymore. Any loss that was there, unrelieved loss that they could have benefited from, that existed before the change, they will not have it anymore. Any claims like these bad debts thing, all right, they will not have it anymore. Carry back losses, all right, on any realization to before the change, they will not have it anymore. So you see what I've said here, and anytime this thing happens, what is going to happen is that the year of assessment will be divided into two. It will be divided into two. Now, it means that the period before the change will be one, and the period after the change will also be another year of assessment. So this one will cause this entity to have what, 2 years of assessment within 1 year. Within 1 year. So there will be 2 assessment years within 1 year. All right, so that is that. Let's look at an example so that you understand this thing better. So look at this example. ABC is a wholly owned Ghanaian company and prepares account to 31st December each year. In 2014, BCD Limited acquired 20% of ABC. So 20% doesn't mean it's not deemed realized. 20% means ABC is not realized. In 2015, so 2014 is 1 year. In 2015, a further acquisition was done. That is 10% in ABC shares. So BCD acquired additional 10%. So right now, 70% is acquired. Still not considered a realization because they still have 70 there. Only 30% is acquired, so it's not deemed realized yet. While DEF also acquired 10%. So it means that now, in the 2015, the second year, they still have 60%. So it is not deemed realized because only 40% is acquired. Then in 2016, you see that BCD acquired a further 5%. Okay, so that makes it 45. So still they have 55. All right, they have 55. Then in the same year, ABC Limited, they bought a 5%. Then DEF also acquired additional what? 15%. So they had 55, 45 had gone. These people increased the purchase by 15%. So there is what? 60. Then it means these people are remaining with what? Only 40%. In that time, there is realization. And this is done within 3 years. This is done within 3 years. So like you see from 2014 coming, ABC had this. By 2016, they are at 40%. In that case, what is going to happen is that ABC is now deemed realized. So the question goes on to tell us that there is a net cost of asset. It says that the net cost of the asset of ABC immediately before the realization is this. So that is the net cost. All right, the net cost. We are not interested much in what do we call it? This net cost. It is just probably to help us derive the realization. So if we are given how much they bought it, we can see how much they also realized. All right. So if we can have an amount about the proceeds they collected, then it means that we can actually have the net cost and the gain. All right. Now it says that ABC have unrelieved finance costs. You remember we said that since it has happened, they won't get that. So they will be denied of this. It's just right here in front of you. We said that if these things happen, finance costs, they will not get it. So they shall not, all right, deduct finance costs. They won't have it. They won't have this one too, section 17, unrelieved losses. They won't have anything. Their bad debts, they won't have it. All right. Then losses also before, they will also not have it. So you see, since that thing has happened, they won't have this. Unrelieved losses, they won't have it. Then again, there is this refund. So the refund is the other one. That one too, they won't have it. A refunded amount. All right. It says that ABC refunded an amount of 1234.5. All right, to Mr. Takoko in January 2016 for a television set he bought from ABC. All right. So, and it says in February 2015, which became defective before the expiration of the guarantee period. This means that this Oga will not have this amount also. All right. The amount refunded to Mr. Takoko, they will not have as a deduction anymore. All right. So that is that. Then again, there is another one here. One of the debtors who owed has gone bankrupt. So bad debt too, you won't be allowed. All right. The financial change of ownership took place in 31st. So it means that since they prepare account from January to December, the first year of assessment will be from January 2016, so 01/01 2016 to 31st, all right, July 2016. And the second year of assessment will be what? Will be from 1st August, right? 2016 to 31st December, all right. So you prepare the account to when they were in themselves, then also from where they weren't existing, all right. It will be a different timing altogether. All right. So basically, these are what you need to know about what realization of capital asset. The next thing we will go on to look at is the realization of depreciable assets. So this is it. Realization of depreciable asset. If there is a realization on depreciable asset, what we do is that for here, the gain is actually the proceeds, that is the consideration received, minus the carrying amount, which we call it WDV. All right, the WDV. So it means capital allowance will come in. All right, so basically that is that. But there are certain things we need to understand over here. So watch this. So they said that an entity started a business. This is the day they started a business. This date is important for our capital allowance calculation. All right. So they bought 5 computers on 2016. Then the company purchased additional one in 2017. Then which were valued 4,000. Then they sold in the same year 3,000. So this is what is going to happen. So here we will have like 2 years of assessment, and we are asked to do from compute depreciation allowance for these 2 years. So what will happen? like the way we used to do our capital allowance. So you put your year of assessment 2016, you put your basis period, all right, 0101 16 to 31st December 2016. So just like we used to do our capital allowance. All right, what then will happen? What will happen is that we have the classes. This one is class 1, is that not it? All right, so the cost of those assets in 2016 were 20,000. All right, nothing happened again in 2016, which means that we need to find our capital allowance. This thing is 40%, and we started business in 1st January, so the days are 365 over 365. And when we do that, it will give us what? 8,000. So that is our capital allowance. So it means our WDV will be 12,000. Then when we come to the year of assessment 2017, YOA 2017, BP 0101 2016, it's first 2017, our WDV brought down is 12,000. Then they acquired additional one. So addition, this is class 1 to 3. So addition is added 4,000, right? That gives us 16,000. But they also dispose what? So disposal. All right. This is the consideration. So the consideration received is what? 3,000. All right. So what then is going to happen? What is going to happen is that if we now determine this, we are going to have 13,000, right? 13,000. That is our depreciable basis, or what we call depreciation basis, or in FR we call this one tax base. All right, then we will now tax this thing at what? 40% of 13,000. And how much would that give us? 0.40 by 13,000. That is 5,200. So that is that. That is that. So we have a difference of so if I take this figure, we have a difference of 7,800. All right. So basically, that is that. That is 2017. So they say that the company then sold 3 out of 4 assets remaining for 20,000. So you see, at this place, we come here 2018. Then we have, how much do we have? We have, so let's do the BP 0101 18 to 31st of 18. So WDV brought down is 7,800. We don't have any addition, so disposal. So you see here, what you should understand is that you cannot dispose more than you have. So our disposal here will be limited to the 7,800. So that is what will happen. To be limited to 7,800. So here you will limit it to 7,800 so that the asset will no more exist. Then what is the difference? They actually sold this thing. So it was 20,000 minus 7,800. That 20,000 minus 7,800, it means we have this 12,200. Now this 12,200 will be added to the income of the business. Okay, so this one added to income of the business income, gain from realization. But you see the other one, when we had a gain, we said we could tax it at what? 15%. You remember? Yeah, 15%. Okay, so that is that. That is that. All right. So that is how these depreciable assets and capital assets are dealt with. All right. So basically, that is that. So you have to reduce it only up to, okay, only up to the amount, the WDV, and the excess is taken and added to your business income, so that here the pool will be closed. All right. So basically, that's it. All right. So, what if when we sold this thing we had a loss? What will happen? So, if probably we sold it and let's say, instead of selling it at 12,000 here, we sold it at, let's say, what amount? Let me use any amount like 5,000. So what is going to happen? You also do the 5,000, all right, and you realize that there is a loss of about 2,800. Okay, there is a loss of about 2,800. So if there is a loss of about 2,800, that loss, all right, you will have will be kind of an additional capital allowance. All right, so you take that loss as an additional capital allowance. All right, so that you will still dissolve the pool to zero. So take that loss as an additional capital allowance. All right. So that is that. It's basically like saying treat the loss as an additional expense. If the positive is an income, then the negative will be an additional expense. So basically that's that. So you grant it as an additional capital allowance. So basically that is that. That is all on the realization. You just have to take your time and go through the past questions. So for example, we have this question 1 in front of us. And what the question 1 is asking for is that we should compute the tax payable. It says that Mama V Deke purchased a land in Ho. So this is land, okay? This is land issue. Voter region, and it cost what? 200,000. In 2011, she spent 8,000 in grading the land. In March 2019, she spent another 10,000 reshaping the land with the intention of selling. Mama V engaged a valuer in June 2019. So this is building up to the cost. All right. Then in July, she placed an advert, still building up to the cost, which is also 1,000. So it doesn't matter the timing of the expenditure, it is still the cost. She now sold the land for 300,000. So it means we need to do gain or loss on inflation. So consideration is what? 300,000. Then the cost. The cost includes how much she bought it, which is 200,000. Then she spent 8,000. So add it. She spent another 10,000. Add it. Another 2,000. Add it. Another 1,000. Add it. Okay, so that is that. Is that all? In October, she sold the land, to Kalika and an agent commission of 2%. So agent commission again, 2% of the sales value. So 2% of 300,000. So that is that. Another cost. That is what? 2% of this should be like 6,000. All right. So she took that cost too. All right. So that is that. And a legal permit of 600. Yes, that is another cost. So you see, you have to add all these costs. You have to add them. So let's add 200 plus 8 plus 10 plus 2 plus 1 plus 6 plus 0.6. That is 227,600. These are all the costs. Did he replace it? No, there's no replacement. So which means that since there is no replacement, we just have to less 3. All right, 300, which means that her advantage is what? 72,400. This one, she can tax it at 15%. Okay, so if she's to tax this one at 0.15, she will be paying what? 10,860. All right, or she can decide to go and add it to his business income. All right, and if you go and add it to your business income, you'll be taxing it automatically at your business income tax rate of like 25%. So always you have to do this. All right. Okay, unless you have so much reliefs, you can negate from these things. So that is what you are doing for 5 marks. All right. So and it says that an individual may realize an asset on death of another person by way of transfer of ownership. What is the tax implication to that? Do you remember? We said that if an individual dies, the amount that is deemed realized is equal to the market value all right, of the asset at the time we say that the person died. So that is equal to the market value. The person who is also receiving the thing is also deemed at acquiring the thing at a market value, which is equal to the market value at that same time. So that is that. That is that. So the person realized, the person we say who has realized the thing, like who has parted with the thing, it will be the market value at the time of realization. I mean, at the time of parting, okay, realization. So that is that. And so this one will be the consideration. This one will be the consideration. Okay, so that is that. So we said that that is the amount. But at the same time, we says that the person who is buying the thing, okay, who acquires the thing is also treated as, I mean, the consideration is equal to probably the cost. That is what we mean. You have derived an amount that is equal to the value of the thing at that date. And to the person who bought it to, it is the same value at the time the person acquired it. So basically that is that. So we say that transfer upon death is that the individual is treated as, the person who died is treated as derived an amount that is in respect of that asset that has been realized as equal to the market value. All right. Then the person who acquires it is also treated as incurring a cost that is equal to the same amount, the market value at that time. So it means that it's kind of an equal to, but just don't say there is no gain. Just say it is equal to. Basically, that is that. This one too is the same thing. Miss Madina purchased a house. Okay. All right. So this one is a house. All right. So a house includes a land. So be careful. The acquisition for this is the acquisition expense incurred amounted to 50. Okay, so it means that when he was buying the thing, he bought it at 400,000. All right, and incurred 50. In June, Parquet sold the thing for 700. So already we had a cost of what? 450, right? We had a cost of 450. And he's receiving 700. He said that whilst he was selling the thing at 700, he incurred all these costs. All these costs, 10,000 agent commission. So you add 10,000 solicitation, because all these things are costs that he has incurred, all right, in selling the asset. He says this one is income tax on rent collected by estate agents, income tax on rent. So this is not part, this shouldn't be part of the cost. It shouldn't be part of the cost, because you are talking about tax paid on rent. Okay, so that is, it's a rent that it's an income tax, all right, that you have to pay. So that is not because you are selling the thing. All right, so this one, then we have valuation fee. So apart from this, add everything all together. So it will be 450 plus 10 plus 8 plus 3 plus 10 again, then plus 20. So together it will be 501. So it's the 501 you are going to compare to this minus 700. All right, you have 199, and that is the gain. That 199, you have a choice to tax it at 15%. All right, and if you are going to use that one, 15% will give you 29.850, like this. So that will be the tax payer. All right, so basically that is that. So take your time and go through almost all the past questions. It says that Parquet also sold, okay, in 2019. So there is actually a continuation to this question. So let's see. So she sold, Papadeke also sold for 1 million in September. The Ghana government security, which cost 800,000 in the year. The incidental selling expense amounted to 50,000. So this is the same thing. All right. This is the same thing. But this asset was a building. This one is a investment property. So the building included land. All right. So that is that. So what are you going to do? What we are going to do is that the consideration received is this. Then we have 850. You have 150. You know how to tax it. All right. So basically, that is that. All right. You know, what you need to understand is that we have PPE and we have what we call an IP. It's something you need to understand. A PPE is a building, but you are using that building for your production of an income. In that case, it is what? A depreciable asset. You can have the same building, but you're using it for rental purposes or capital, you are keeping it for capital appreciation. That one, it becomes an IP and it becomes what? An investment asset. So that is the difference. All right, that is the difference. Other than that, we would have done class 4 for the building. All right, so please understand the differences. Okay, there's a difference between what you are using to produce income and what you are using for rental purposes and for capital appreciation. So that is why, other than that, we would have done the capital allowance for the building. This building is not for use of income, as in they are using it as a business. They are keeping it as a investment property. That is why we did that. All right. So there is another example you can look at. Abena bought 2 mansions, one in East Legon, one in Kwadaso, on these dates. This is the cost of them. So you have 2 costs, respectively. Abena Morgan lives in the property in the East Legon lives in the property in the East Legon. And on March 2019, she used 250 to convert the apartment to a self-contained flat to be able to sell it over here. Okay. So as she is living in, this is not a business thing. It is a personal house. The moment she decides to convert it, this is the process she is having. Okay. This is the process she is having. All right. And that is what you can get. Is she is getting a 303.3. So she sold it to a younger brother. All right, to a younger brother. So we've seen that one here. The property in Kwadaso also consists of 2 detached bungalows, and she sold one of the bungalows for 6.3 in this date. Now it's said that, why I'm saying that is this sister is that it is not at arm's length. But the market value of the apartment she sold to a younger brother at the time of the sale was 4 million. So you will ignore this one because we use market value for the sale. So the consideration will not be the related party one. It will be the arm's length one, which was 4 million. So that now the cost incurred in converting the thing will now be deducted as what? 2.5. So therefore there is what? 1.5 gain. Please, as at before all this, before doing this, she was living in it. She was living in it. All right. So that is not a business thing. All right. So please take good note of how these things work. All right. Take good note. So therefore, we says that this is it. While the bungalow two at the time she was selling it was this. Okay. So the total bungalow in Kwadaso is what? 11. This is the cost, right? In the East Legon one, she was living in it. In the other one, it was an investment property. And this is the cost. And it says that this cost includes it's 2 parts. There is a part that, so here it says that there is a part called, if she sold this part, whilst the bungalow what was it? The market value of we have this. Said that, yeah, Kwadaso one has two detached bungalows. And she sold one of the bungalows to her elder sister at this. This is the amount. But the market value proper is this amount. So that part she sold, all right, it says that what the market value of the bungalow sold to her at that time was this amount. She had used 19502 to furnish the bungalow that was sold to her sister. All right, so that is an additional cost. Okay, so the market price of unsold bungalow is on this date is 11 million. 11 million. So that is what we have. So that bungalow, this one, all right, that is the bungalow. Now we are told that the market price of the unsold, it means that the thing is 2 now. So what we're going to do is that there's a part that is being sold, there's the part that is not being sold. So the total value of that bungalow, the total value is equal to 8750 million. And the part that is not sold, that one is 11 here. So in total, the bungalow, this is 19,750. So the part that is being sold is a portion of this. So what we are going to do is that we need to find the cost. So cost. So this is it. The cost part of the part that is being sold will be 8750 out of the 19,750 multiplied by this cost of the building. All right, we need to find the cost. As for the consideration there, we know that we've collected. This is the part. She used this amount to furnish the bungalow. So that is an additional cost. All right, that's an additional cost. But as for the consideration that she received, it is clear that she received 8750. That's the market value. So this one, what we will get then, an additional cost of 1950. So how much will we have? Why are we doing this then? Because the cost, this one, is for the entire Kumasi. The entire Kumasi. So how will we know the cost of the part that was sold? That's why we are doing the split. That's why we are doing the split. Because it says that the market price of the part that is not sold is this. All right. So the part that is sold plus the part that is not sold gives us the total price of the thing. All right. So that is the reason why we are doing that. So 8750 divided by 19,750 multiplied by 11,500. That gives me 5094938. So if I add it to this one plus 1950, the total cost therefore will be 7044938. So that is what I have. All right. So that gives me the total cost. All right. Then consideration. We all know our consideration for the selling part is 8,750. So if I take that one out, 8,750, what you'll be getting is that the gain is therefore 1,705,063. So that is the gain. And this gain is the one we'll be taxing at what? 15%. So if you want to tax by 15%, multiply by 0.15. The tax payable, therefore, is 255,759. All right. So basically, that is that. That is that. All right. So you have to be very, very careful about these things that you have to do. Okay. So you have that value. All right. That is the value that you have. And that is the Kumasi part. There is another part also that we did, which was what 1.5, right? That was the gain. So you can decide to tax this one at 15% or just add the 2. So you tax this one. You can also tax this one at 50%. Then you add the two figures. All right. Or just add the two before you tax at 15%. That's all. So the 1.5, you will tax the 1.5 at 0.15%. So that one alone is also 225. All right. So it was 1.5 and it is 225. So 225,000. So in the end, you add the two together. All right. So here will be, let me add plus 255. We have 480,759. So that's all. The total. That's all. So take your time. Go on and solve the rest of the question. On the death or divorce, I mean, that one to remember, they say money. All right. They say money. So the net cost is the same. All right. But it's just that the person who will get the asset, if she sells it later, there will be what? A gain. All right. That is that. And you have this one to retain earnings. Intends to increase its capital and it applied to the registrar general. The balance brought down of his retained earnings. Transfer from income 1.2. What do we have here? Transfer to, please, anytime they transfer money to stated capital, do you remember 0.5 stamp duty? Then what? The money they transfer to 8%, okay, deemed dividend. So you tax this 600 at 8% and tax the same 600 at 0.5. So that is that. So 0.5% of the 600 will go to the registrar. It doesn't go to GRA. All right, registrar. Then 8% deemed dividend. That money is called deemed dividend. And you tax that one 8%. So 0.5%, all right, multiplied by 600,000. That means you pay 3,000 to the registrar. Then 0.808 by 600,000 will go to GRA, 48,000. So basically, that is that. So you're just doing this thing for 5 marks. So that's all. That's all. You have this question says, I will leave these ones to you to go through. All right, because it says that he's a shareholder. He purchased ordinary shares, 100 ordinary shares for 50,000. So just make the pricing. So what you do is that this man bought shares, right? So first of all, he bought 100 shares, which means that for 50,000. And in June, he bought additional 100 shares. So additional 100 shares, 100,000 shares. The price is this 0.6. So just multiply 0.6. That one to will give you like 60,000. So he's been buying shares. So each time he buys, it increases his share capacity. On the day that he will sell, he will get his profit. So you just put the date here, do what you are doing. All right. And it says that on January 2020, Mama accepted the right issue for. So it means that at this time, he's having 200 shares. And it says that he accepted the right issue offer for 1 share for every 10. So it means that for every 10, so out of the 200,000, for every 10 she's collecting an extra 1. So what is that? That is 20, right? So she will have another 20 shares. What is the value of that 20 shares? 0.5. So 0.5, 20,000 by 0.5 is 10,000. So it means she has 10,000. That is it. In December, she now sold. So together, she has been selling. So right now, she has 220 shares. And the value of all his shares in there, this is 110, so 120, right? 120. Now she's selling 50 of the shares, so 50 will be deemed realized. All right, for 60,000. So together, we need to find the value of these shares. All right, the cost of the share. Then we need to now, so proceeds she has received is 60,000. No doubt about that. So she has a proceeds of 60,000. So, and it says that paying 2% of the sales value as brokerage. So it means that even the 60,000 she paid, yeah. And the current market value of share is what? 1.12. 1.12. So that tells you that if the current value of share is 1.12, then it means that all his shares that he has, all right, sorry. So you see, all his shares that he is having will have that value. Okay, so how many are the shares that he is having? So including even this one is 170,000. So that 170,000, the value of that 170,000 shares is going to be how much? It's going to be 170 by this. 170 by this. So the current market value price per share is what you have here. So if we now want to have the cost, what we are going to do is that this is it. The cost of shares, okay, let me do the consideration. So this is it. Consideration is 60,000. Then cost, we have two, right? We have two of the cost. So cost. The cost of all shares is 1.12. All the shares that she is having, 1.12. So all the shares that she's having, and she sold this one at this date. So this one, the value of selling is 60,000. This one, the value is 1.12. So that is what is going to happen, because this is what he had. Unless the question is telling us that he sold it to a related party. Therefore, so because it says that at the 1st December, he sold 50,000 shares for this, paying a commission via so of the value to a brokerage. So who facilitated the sale? So it means that it's not him who negotiated anything. So it means this value. So let me see, 170 by 1.12 is 190. 190, 400. Which means that this one will be, the total value of the share will be 250, 400. Now, why didn't we multiply the entire 220 by 112? He is not the one who did the sale. So the market value of the one that the broker did, because he is not part. The broker is the one that will do that. He's not part, becomes it. So the part that he now sold, all right, the money that he's now getting, like the way we did the other way around, is going to be the cost of the amount he's receiving. So what we do is that the market value of the share sold all over the total value. So this is the market value of shares sold all over the market value of all the shares before the sales. Before sales. Yeah. And we are going to now multiply this figure by the cost of shares before the sale. This is his cost. That is his cost. But this cost, as we have in here, included all this one and this one. So what is the cost? 120,000. So what we are going to have is that 60,000 out of the 250, 400 multiplied by the 120,000 will be the first part of the cost. All right, then the additional cost. The additional cost we are told is what? 1,002, right? Because we calculated it before. It's 2% of 600. It's 12. 60,000. Yeah, that's it. 12. 12. 12,200. Basically, that is that. All right, so how much will we get for this? 60 by 250.4 multiplied by 120. And that gives me 28.754. All right, so in all, if we less everything, that is, we have 30,046. All right, because that is that, and this is what we are going to tax at 15%. Okay. So now, what you need to be careful about is this part, because you need to generate the total cost of all the 220 shares. This is the total cost. That is the total cost. All right. So we have sold 50 out of that. So you could have, let's say, if this is what we have at the point. Let's say it is 120 divided by 220. So like 0.545, so let's say 0.55 rounded. So that is the cost of shares over there. And he is selling 50,000 of his shares. So technically, if you want to even generate the cost from there, it will be like 27272. But we all know that that is not the market value, proper cost of shares in the market. So the market value of the share is actually the cost. So you have to multiply that figure with what is actually the cost in town. The cost in town is 1.12. That is actually the cost in town. So even this one, we will have to revalue this figure, all right, to the current state. So, and if you are selling, and don't forget, it's not just about the proceeds he is receiving, it's about the cost. As at the time they are selling the thing, the cost of the thing is 1.12. So the part which they didn't sell is that. But this part that they sold, it is the broker that determined it. It is not him. All right. So basically, that is that. So please be careful. Be careful. There is a similar calculation in one of the past questions too. Let me see. There's a similar one you need to find out. Yeah. So I will leave you to do this. So be able to do this. Realization of assets. A gain made from realization of assets is the total consideration. What is an asset realized? Oh, parting away. You list all the examples of parting away. All right. Parting away. In case of depreciable assets, in case of trading stock, in case of capital assets. All right. So, ladies and gentlemen, try and do the remaining examples. All right. Thank you so much. And this brings us to the end of lecture 10, right? Or lecture 11. Have a great day.